What if I told you that right now, in 2026, there are regular people, not Wall Street traders, not trust fund kids, collecting $1,000 every single month from simply owning stocks that pay them like clockwork? And the craziest part? Once you set it up, you don't have to do anything. No landlords calling you at 2 a.m. about a busted pipe. No algorithms to chase. No inventory to manage. Just money hitting your brokerage account while you sleep, while you're on vacation, while you're binge watching Netflix on a Tuesday afternoon. That is the power of dividend investing. Today, I'm going to walk you through the exact 5-step blueprint I use to build a portfolio that generates $1,000 a month in pure dividend income. And I'm not going to gatekeep a single thing. You're getting the math, the tickers, the allocation percentages, the strategy, all of it. Whether you're starting with $500 or $50,000, this framework works. So stick around, because step 4 is the one that changed everything for me. And most people skip it entirely. Let's get into it. Step 1, know your number. Before you buy a single share of anything, you need to understand one critical number: your target yield. Most people hear $1,000 a month and they think they need to be a millionaire. That's not true, not even close. The amount you actually need depends entirely on how much your portfolio yields. And this one calculation changes the entire game. Here's the breakdown. If your portfolio averages a 3% dividend yield, you'd need about $400,000 invested to pull in $12,000 a year. That's your $1,000 a month. Sounds like a lot, right? But bump that yield up to 5%, and suddenly you only need $240,000. Push it to 7%, and you're looking at roughly $171,000. Now, before you go chasing 10% yields thinking you found a cheat code, pump the brakes. Ultra-high yields are usually a red flag. They often signal a company in financial trouble, a stock price that's cratered, or a dividend that's about to get slashed. The sweet spot for most investors in 2026 is between 4% and 6%. That range balances strong income with portfolio stability, and that's exactly where the smartest wealth builders operate. So grab a calculator. Divide 12,000 by your target yield as a decimal. That's your magic number. Write it down. Make it your phone wallpaper. Because everything else in this blueprint is designed to get you to that number as efficiently as possible. Step 2. Build your core with battle-tested ETFs. Now that you know your number, it's time to pick your weapons, and this is where most beginners mess up. They start cherry-picking random stocks with high yields and pray it works out. Don't do that. You will get burned. Instead, start with your core. This is the unshakable foundation of your dividend portfolio. Broad, diversified, low-cost ETFs that do the heavy lifting for you. Think of it like the engine of a car. Without a strong engine, the nicest paint job in the world won't get you anywhere. Here are the 4 ETFs dominating the dividend space in 2026. First, SCHD, the Schwab U.S. Dividend Equity ETF, the undisputed fan favorite in the dividend community, and for very good reason. It focuses on quality U.S. companies with strong fundamentals and a history of consistent dividends. It yields around 3.6% and has delivered a total return of nearly 48% over the last 3.5 years, with dividends reinvested. SCHD is your slow and steady, sleep well at night wealth builder. Second, VYM, the Vanguard High Dividend Yield ETF, casts a wider net across hundreds of high dividend large caps, currently yielding about 2.4%, but here's the kicker. Its total return has actually beaten SCHD over the same period, clocking in around 65%. VYM is less about immediate cash flow and more about total return with dividends baked in. If you have a longer time horizon, this one's an absolute beast. Third, JEPI, the JP Morgan Equity Premium Income ETF. This is where things get interesting. JEPI uses a covered call option strategy to generate income on top of dividends, which is why it yields above 8%. Yes, 8%. Its total return is more modest at around 44%, but if your goal is maximum cash flow right now, JEPI is a powerhouse that pays you every single month. Fourth, JEPQ, JEPI's NASDAQ-focused sibling. Same covered call strategy, but targeting tech-heavy names like Apple, Microsoft, and NVIDIA. JEPQ has returned over 82% since mid-2022 and also pays monthly. If you want tech and AI exposure while still collecting fat dividend checks every 30 days, JEPQ is your play. My recommendation? Allocate about 60% of your total portfolio across these core ETFs. Use SCHD and VYM for stability and long-term growth. Use JEPI or JEPQ for higher immediate income. That blend gets your average yield somewhere in the 4% to 5% range, right in that sweet spot we talked about. But here's what separates this blueprint from the generic advice you'll find everywhere else. Most people stop here. They build the core and think they're done. They're not even close. That's exactly why Step 3 exists. Step 3, add satellite holdings for income acceleration. Your core gives you the foundation. Your satellites give you the edge. This is where you layer in individual dividend-paying stocks and REITs that boost your overall yield and add serious diversification to your portfolio. Let me give you the names that absolutely belong here right now. First, Realty Income, ticker symbol O. This company literally trademarked the phrase the monthly dividend company. They pay dividends every single month, yield about 5% at roughly $65 a share, and have increased their dividend 133 times since going public. That is not a typo. 133 consecutive dividend increases. Realty Income owns over 15,000 commercial properties leased to essential businesses like Walgreens, Dollar General, and FedEx. When people talk about reliable passive income from the stock market, this is the stock they point to. Then the dividend aristocrats, elite S&P 500 companies that have raised their dividends for at least 25 consecutive years through recessions, market crashes, pandemics, and everything in between. Names like PepsiCo, Caterpillar, and Kimberly-Clark. Morningstar's top undervalued picks for 2026 include Clorox, with a 4.37% forward yield, currently trading at a 30% discount to its fair value estimate, and Air Products and Chemicals in the industrial gas sector. These are companies that have weathered every economic storm imaginable and kept paying you more every single year. Allocate about 25% to 30% of your portfolio to these satellite holdings. Aim for a smart mix: monthly payers like Realty Income, quarterly aristocrats like PepsiCo, and a couple of higher yield sector plays across real estate, consumer staples, and industrials. Together with your core ETFs, you should now be averaging between 4.5% and 5.5% overall portfolio yield. And here's what most financial gurus won't tell you. It's never about finding one magical stock that does everything. It's about engineering a system where multiple income streams overlap, reinforce each other, and create true resilience. Which brings us to the step that truly separates amateurs from the pros. Step 4. Turn on the drip and let compounding do the work. If you take nothing else from this entire video, let it be this. Turn on DRIP. DRIP. Dividend Reinvestment Plan. This single setting in your brokerage account, Schwab, Fidelity, Vanguard, Robinhood, wherever you invest, automatically takes every dividend you receive and uses it to buy more shares of that same stock or ETF. Zero action required on your part. Why does this matter so much? Two words: compound growth. When you reinvest dividends, you buy more shares. Those new shares generate their own dividends next quarter. Those dividends buy even more shares, and the cycle accelerates over time like a snowball rolling downhill, getting bigger and faster with every single rotation. Let me put real numbers to this. A $10,000 investment at an 8% yield with 4% annual dividend growth turns into over $32,000 in just 10 years with DRIP turned on. Your income more than triples without you adding a single extra dollar out of pocket. A 3% yield with 5% dividend growth, that doubles your income in roughly 14 years through compounding alone. Here's the psychology trap most people fall into. They see those early dividend payments, maybe $15 here, $22 there, and they think, that's nothing. What's the point? The point is that compounding is invisible in year 1. It whispers in year 3. It talks in year 5. And by year 10, it absolutely screams. Nearly 900 companies on U.S. exchanges run their own DRIPs, and virtually every major brokerage now offers commission-free automatic reinvestment, including fractional shares, so not a single cent gets left sitting on the table. The rule is dead simple. During the accumulation phase, where most of you watching right now are, never take dividends as cash. Reinvest every single penny until you hit your target number from step 1. That is the fastest path to $1,000 a month in passive income, period. Step 5. Protect your income with tax-smart moves. You can build the perfect dividend machine, but if you ignore taxes, Uncle Sam is going to take a massive bite out of your returns. This part isn't sexy or exciting, but it might genuinely be the most important step of all. First, understand the critical difference between qualified and ordinary dividends. Qualified dividends from U.S. corporations where you've held the stock at least 61 days are taxed at the long-term capital gains rate, 0%, 15%, or maximum 20%, depending on your income bracket. Ordinary dividends get taxed at your regular income rate, which can be as high as 37%. That difference alone means thousands of dollars, either staying in your pocket or flying straight to the IRS every single year. 2 moves to make right now. First, prioritize qualified dividend payers in your taxable brokerage account. PepsiCo, Clorox, SCHD, and VYM all primarily pay qualified dividends with that preferential tax treatment. Second, and this is the big one, put your high-yield, non-qualified income generators inside tax-advantaged accounts like a Roth IRA. JEPI's income comes largely from option premiums taxed as ordinary income. Inside a Roth, that income grows and compounds completely tax-free forever. This one move, strategic account placement, can save you thousands every single year, and the vast majority of investors never even think about it. One more thing specific to 2026. With the Fed adjusting rates downward, dividend stocks are increasingly attractive compared to savings accounts and bonds. The national average savings rate has dropped to just 0.39%. Meanwhile, a well-built dividend portfolio yields 10 to 15 times that amount. Institutional money is rotating heavily into dividend ETFs right now, and smart retail investors are following that exact same flow, bringing it all together. Full blueprint recap. Step 1, know your number. At a 5% blended yield, that's $240,000. Step 2, build a rock-solid core with SCHD, VYM, JEPI, and JEPQ. Step 3, add satellites like Realty Income and Dividend Aristocrats for income acceleration. Step 4, turn on DRIP and let the compounding snowball build momentum. Step 5, use tax-smart account placement to keep more of every dollar you earn. Here's the honest reality check. Most of you watching don't have $240,000 sitting in a bank account right now. That's completely fine. This blueprint isn't about having the money today. It's about building toward it with consistency and discipline. If you invest just $500 a month into this kind of portfolio, with drip turned on and average 5% annual dividend growth, you can realistically hit $1,000 a month in fully passive income within 10 to 12 years. Start earlier, contribute a bit more, and that timeline shrinks dramatically. The hardest part isn't the strategy, it's starting. It's clicking buy for the first time. It's trusting the process when your portfolio is small and the dividends feel laughably insignificant. But remember, every dividend aristocrat that's been raising payouts for 25 or 50 straight years started with one quiet quarterly check that nobody noticed. So here's what I need you to do right now. Drop a comment below. Which step are you currently on? Are you at step 1, figuring out your magic number? Or are you already deep into step 4, watching compounding do its thing in real time? I read every single comment, and I will personally reply to as many as I can. If this video opened your eyes to what's actually possible with dividend investing in 2026, smash that like button. It costs you absolutely nothing, but helps this video reach more people who desperately need to hear this. Share it with a friend or family member who's still keeping all their savings in a checking account, earning next to nothing. And if you haven't subscribed yet, seriously, what are you waiting for? Hit subscribe and turn on the notification bell so you never miss a video. I've got an entire passive income series dropping very soon. And trust me, you do not want to miss what's coming next. Your future self is going to thank you for what you do today. I'll see you in the next one.